At 2 o'clock in the morning, while Delhi slept, a secret operation was underway at a government warehouse. Guards watched as heavy, unmarked metal trunks were loaded onto a chartered aircraft. These trunks contained 67 tons of gold, the collective wealth of a 5,000-year-old civilization. This occurred in 1991. The plane was bound for London, carrying the nation's gold to be pledged at the Bank of England. The patriots who authorized this flight were forced into a corner. With no other options remaining, they chose this path because the nation stood at the edge of bankruptcy. The crisis was the result of the License Raj, a system of central planning and strict government control established after 1947. While it was intended to protect the new nation, it eventually stifled growth and isolated India from the global economy. This chart shows government income against expenditure over a decade. Revenue remained stagnant, while spending climbed constantly, fueled by borrowing abroad. By 1991, the fiscal deficit hit 12.7%. The expanding red area shows internal debt climbing to 53%, a massive burden. The system had entered a destructive loop. India was taking out fresh loans simply to pay the interest on its previous debts. In 1990, external shocks accelerated the collapse. The Gulf War caused global oil prices to double instantly, increasing India's import bill by 60% in a single year. Simultaneously, the Soviet Union collapsed. India's largest trading partner vanished, closing off a vital market for exports overnight. Domestically, the government was in chaos. 3 prime ministers held power in just 3 years, leaving the country with weak leadership and little appetite for difficult decisions. In May 1991, the assassination of Rajiv Gandhi shattered what remained of international investor confidence. Foreign capital fled the country, and credit agencies downgraded India to the lowest investment category. This countdown shows the remaining foreign reserves. India had $1.2 billion left, enough for 15 days of essential imports like food and fuel. Hitting zero would mean a sovereign default. India would lose the ability to buy basic necessities, impacting the life of every person in the country. To secure hard currency, the government authorized the pledge of 20 tons of gold to Switzerland and another 47 tons here to the Bank of England. These shipments secured $639 million. The gold was moved under total secrecy to prevent a panic. When the news broke, a storm erupted in Parliament and on the streets. The press and the opposition branded the secret operation a national humiliation. While the public was outraged, the government viewed this as an agonizing necessity, the only way to keep the country functioning. Beyond the political noise, one man understood the logic of the gold airlift. He saw it as a way to buy the country time to change. Dr. Chakravarthi Rangarajan brought the perspective of a monetary economist to the central bank. Educated at the University of Pennsylvania, he had spent his career studying how policy affects markets. As deputy governor of the Reserve Bank since 1982, Rangarajan had spent 9 years analyzing the architectural flaws in the economy. He saw the crisis coming long before it arrived. While others focused on the immediate panic, Rangarajan was already designing a solution. He chaired the Committee on Balance of Payments, creating the blueprint for the reforms that would eventually follow. The gold shipments provided a few weeks of breathing room. They were not a cure for the systemic disease, but a way to prevent immediate collapse. Rangarajan and his team used that purchase time to orchestrate a permanent economic transformation, shifting India away from the License Raj and toward the global market. The gold was gone, across the dark ocean, but in the silence of that secret night, a nation's reckoning had begun, and one man, Dr. Chakravarthi Rangarajan, was Mumbai, December 22, 1992. Inside the fort area sits the Reserve Bank of India. It is a stone and steel fortress, where the decisions made echo directly into the lives of 1 billion people, dictating the price of a loaf of bread or the interest rate on a small business loan. On that Tuesday, a quiet, deeply thoughtful economist named Dr. Chakravarthi Rangarajan stepped into the governor's office. He was a technician, appointed not to play politics, but to execute an overwhelming mission. India had narrowly avoided default the previous year, but the crisis was far from over. The national gold supply was still pledged to foreign banks and had to be brought home, while massive IMF loans were coming due, and the foundation underneath those debts was broken. the country operated with a heavily controlled exchange rate, a banking sector rotting from within, and a government severely lacking fiscal discipline. To prevent a second economic collapse, Rangarajan had to methodically overhaul the system from inside the central bank, and do it quietly enough to avoid sparking a fresh panic. He didn't have to do it completely alone. Rangarajan formed a remarkably cohesive, egoless alliance with Finance Minister Dr. Manmohan Singh. They established a clear division of labor. Singh managed the political minefield and worked to reduce the government's massive deficits. Rangarajan applied his technical expertise to stabilize the currency and restructure the banks. One handled the fiscal side, the other handled the monetary side. Their ability to push the government and the central bank in the exact same direction became the engine driving India's economic recovery. The most immediate problem was the rupee. For decades, the Reserve Bank dictated the value of the currency rather than letting the market decide. They set an artificially high rate, which made Indian exports too expensive to sell abroad, and foreign imports artificially cheap to buy. This chart shows the fatal flaw. To maintain that rigid exchange rate, the government burned through its foreign reserves, sending savings plummeting. The 1991 shock devaluation pulled the currency down sharply to stop the bleeding. But a sudden drop doesn't fix the underlying mechanics. Rancorly, in 1992, he introduced a dual exchange rate system, allowing 60% of export earnings to be determined by the open market, while 40% remained at the official government rate. A year later, in March 1993, he scrapped the dual rate. The rupee became fully convertible on the current account. From that point on, global market forces would dictate the currency's true value, with the central bank only stepping in to prevent extreme volatility. Critics predicted hyperinflation and disaster. Neither happened. The currency stabilized, Indian exports became globally competitive, and trusting the reality of the market proved far safer than maintaining a government fiction. With the currency floating safely, Rangarajan turned to the domestic economy. Indian banks were in a state of severe internal decay. They functioned less like actual financial institutions and more like political instruments, forced to lend money wherever the government ordered, regardless of whether the borrower could actually pay it back. He began dismantling the old rules. He removed the strict administered interest rates and reduced the heavy reserve requirements that forced banks to park their deposits in government securities, suddenly freeing up vast amounts of capital. In return, banks were subjected to strict new mandates. They had to truthfully classify their non-performing loans, assess borrower risk with actual math, and keep emergency capital aside to cover their inevitable losses. Think of these rules as the essential infrastructure of an economy. Rangarajan was flushing out the blockages and re-engineering the hidden pipes required to properly channel money from savers directly to productive businesses. It was unglamorous work, but without fixing that invisible plumbing, the massive trade and currency reforms happening above ground would never have actually reached the public. By 1993, Rangarajan faced his highest stakes threat yet. The government, under intense pressure from upcoming elections, demanded money. They had a long-standing tool called ad hoc treasury bills, which legally allowed them to force the Reserve Bank to print unlimited cash to fund their political deficits. Economists call this fiscal dominance, a condition where political ambition has a stranglehold over a nation's monetary policy. Rangarajan refused to comply. In September of that year, during a historic lecture in Kolkata, he drew a firm public line against his own government. He argued that a central bank stripped of its independence can never guarantee price stability. If the bank acts as an open printing press for election campaigns, it guarantees runaway inflation that destroys the savings of its citizens. He took his argument behind closed doors and won, abolishing the ad hoc treasury bill system. In its place, he negotiated ways and means advances. This allowed the government to borrow in emergencies, but imposed a transparent, market-linked limit on the debt. By severing the direct pipeline between political spending and the nation's money supply, Rangarajan removed the most existential threat to India's financial survival. Rangarajan's tenure at the Reserve Bank served as the architectural foundation of India's modern economic sovereignty. He established the precedent that true national wealth requires an independent environment. one where the currency serves the long-term health of the economy rather than the short-term needs of the ballot box. In the stone and steel fortress of the RBI, a line had been drawn between a nation's purse and its politics. Because that mechanism remains in place to this day, inside the polished Reserve Bank of India offices, the 1991 crisis had technically been averted. But out in the real world, 850 million Indians were waking up to stagnant salaries and climbing prices. C. Rangarajan stepped into the role of RBI governor with a clear philosophy. To him, inflation was a moral problem. Wealthy individuals hold assets they can use to hedge against a devaluing rupee. But when the price of daily essentials like kerosene or cooking oil doubles, families with limited means face an immediate crisis they cannot outmaneuver. Every adjustment to interest rates or money supply carried human consequences. Rangarajan navigated these decisions with a focus on protecting the country's most vulnerable citizens. This diagram illustrates the dilemma of structural reform as a balancing scale. When the government opened exchange rates and dismantled administered pricing, those necessary reforms landed heavily on one side, immediately pushing prices upward. The standard countermeasure is to drop a heavy block of tightened money supply onto the opposing side, raising interest rates to forcefully drive inflation back down. But if you tighten the money supply too aggressively, that block crushes the entire mechanism. Credit freezes, investment chokes, and economic growth stalls completely. Rangarajan bypassed this trap through highly calibrated, gradual adjustments to bank rates and cash reserve ratios. He paired these small steps with markets calm. Maintaining that balance, preventing runaway inflation while protecting economic growth, required constant daily calibration of every available metric. A garment exporter in Tirupur couldn't fulfill orders because he couldn't acquire synthetic fibers. With foreign reserves drained, banks could not issue the foreign exchange needed to import raw materials. The Gulf War had cut off critical remittance pipelines. Thousands of breadwinners returned to states like Kerala and Uttar Pradesh unemployed, cutting off the lifeline for their dependent families. In Delhi, a small importing business watched its debt calculations unravel entirely. Interest rates crept higher while the rupee fell, turning a manageable loan into ruin. Writing in his memoir, Forks in the Road, Rangarajan noted that these individual struggles were constantly on his mind. He knew the macroeconomic equations dictated what actually made it onto a family's dinner plate. Through his calibrated adjustments, the systemic inflationary pressure that had choked the Indian economy for decades slowly began to ease. This chart shows the trajectory of India's foreign exchange reserves. Starting from a depleted baseline of $1.2 billion in June 1991, the reserves surged upward until the IMF loan was completely repaid by 1995. With the debt settled, the physical gold that India had pledged as collateral finally returned. Arriving from the vaults of London and Zurich, the country's most precious asset was safely sealed back inside its own borders. Repatriating those reserves sent a signal to the world. India had kept its promises, and the time of desperation was over. In September 1993, Rangarajan delivered a lecture in Kolkata, arguing that a central bank forced to print money for political purposes can never guarantee price stability. Making the case for central bank independence in a developing democracy was a radical position in 1993, long before it became a global consensus. By 1996, the world's top monetary institutions recognized India as a credible, reforming economy, granting it membership in the Bank for International Settlements in Basel. During his time in office, the country managed to achieve a rare economic equilibrium. Sustainable growth was arriving without the ruinous inflation of previous decades. The gold returned to Indian soil. The promises made during a desperate flight in 1991 had been fulfilled, and the country's credibility was restored. December 21, 1997, Mumbai. Dr. Chakravarthi Rangarajan finishes his 5-year term as governor of the Reserve Bank of India. He exits without fanfare or public procession, leaving behind a city that looks much the same as when he arrived. Inside these walls, however, the structure of the national economy had been reorganized. In 5 years, India moved from the edge of a bankruptcy crisis to a state of measurable stability. This work was largely invisible, conducted through technical adjustments to interest rates and exchange mechanisms. It is the plumbing of a nation. You rarely think about the pipes behind the wall. You simply expect water to flow when you turn on the tap. While the public may not have noticed the specific maneuvers, the international observers and finance ministry officials who watched India navigate its existential threat saw it differently. To them, these 5 years were a case study in precise economic governance. The resilience India displays in the global market today stands on the specific regulatory foundations built during that period. The first pillar was a market exchange rate, allowing the rupee to find its value and boosting exports. Second, he ended fiscal dominance, separating the RBI from the government's budget. By limiting government credit, the RBI gained independence to shape monetary policy and control inflation. The third pillar involved banking reform. He introduced international norms for asset classification and capital adequacy, requiring banks to honestly recognize their losses and maintain specific reserves against risk. Fourth, India joined the Bank for International Settlements in 1996. This was formal recognition that the Indian system met global standards of technical rigor. Finally, he established a culture of institutional integrity. He operated as a technically focused governor who communicated his decisions with a level of clarity and independence that set a new benchmark for the office. These 5 pillars replaced a system dictated by political pressure with a framework that functioned on rules and technical constraints. The strength of this new architecture became apparent during the shocks that followed. After the 1991 crisis, India avoided a repeat of a balance of payments collapse for the next 3 decades. When the 1997 Asian financial crisis caused economies in Southeast Asia to contract sharply, India remained stable, shielded by Rangarajan's cautious external policies. During the 2008 global financial crisis, the largest financial systems were shaken. India's banking sector felt the pressure but did not break. Historically, countries taking IMF bailouts revert to their old fiscal habits. They stabilize briefly, then return to the same vulnerabilities that caused the initial crash. Rangarajan attributed India's different outcome to the fact that these reforms were internally driven. The IMF loan provided the necessary breathing room, but the decision to change the country's economic path came from within. In 2024, the Reserve Bank of India brought 100 tons of gold back to Indian soil from the Bank of England. The move happened quietly, with few headlines and no public celebration. The scale of the change is visible in the reserves. In 1991, India held just $1.2 billion. By 2024, that figure had grown to over $700 billion. While the general public didn't mark the occasion, the 92-year-old economist in Chennai understood the symmetry of the moment. He remembered the night the gold originally left for London. The return of that gold completed a circle. It was the final physical evidence of a promise kept, the retrieval of national assets that had been pledged as collateral during the country's darkest economic hour. In his memoir, Forks in the Road, Rangarajan writes not to seek credit, but to explain the reasoning behind the decisions. He frames his time at the RBI as a series of technical problems that required technical solutions. His tenure teaches a specific lesson. A nation's survival is rarely the result of luck. It is the product of slow, patient, and technically rigorous work performed away from the spotlight. He demonstrated that the most effective way to protect a country is to build systems that function on transparent rules, rather than the individual will of whoever happens to be in power. Dr. Chakravarthi Rangarajan saved India by laying the invisible foundations of a broken nation. He did the work, let the water flow, and those foundations